Hello guys, welcome back to my YouTube channel again. This is the Financial Academy, so you are welcome back again. If you are seeing me for the first time, my name is Financial Academy because in this channel, all I teach is about forex trading, the cryptocurrency trading, the stock trading, and the real estate investment business. So if you are seeing me for the first time, please make sure to subscribe to my channel and also make sure to like this video. Make sure to comment down below if you have any single question concerning any of my video topic. Because in today's video, I'm gonna be jumping straight into the second episode of my journey on teaching you how to trade forex successfully. So this video will be my second episode. So if you have never watched my first episode, click in the video that is popping up or check out the video in my channel that I write it episode 1. Then that is my first episode of this video. So if you're watching this video, make sure you watch the first episode before watching the second episode. Understand? So that you won't be left out, because this video is divided in 12 episodes. So this one is the second episode. In my next video, I'll be going for the third episode. But make sure to watch the first episode so that you will learn the continuation of the second episode. Are you getting my point? So make sure to watch this video from beginning to the end. Comment down below if you have any single question concerning any of this video. Understand? Let me now dive in straight. Let me now go to my screen and continue with the second episode of this video, because I'm in a journey to break everything down for you from the beginning to the end. Everything you need to know and understand about the forex trading and about the forex market in general. So let's head over to my screen and I'll be breaking everything down for you, which is the second episode of my video. Because I have already break down the first episode, which I teach about the introduction of forex trading, the history of forex trading, and the market participants, and who are the hierarchies of forex trading. Now I'm going more deeper in more markets proper in this second episode, so as the third episode. But for now, please follow me to my screen. Let's now dive in properly into the second episode. Let's go.
Hello guys, welcome back to my screen to the second episode of my full forex trading course. Welcome back to my screen to the forex trading course. So this is the second episode of my full forex trading course. Let's continue from where we stop. Forex basics, ultimate beginner's guide to understand the forex market. Understand? So this is the forex basics, because I told you before that this is the second episode. So if you haven't watched the first episode, find the way find the video in my channel and watch the first episode so that you can understand the first episode, then continue for the second episode. Let's move on. Introduction. If you have ever wondered how currencies are traded and how people make money by exchanging them, then you have already taken your first step into the world of forex trading. The foreign exchange market, Forex or FX, is the largest and most liquid market in the world. With over $7 trillion added daily, it's where currencies from around the globe are bought and sold, and where traders aim to profit from changes in exchange rates. So in this video, we will break down the basic of forex trading, how it works, key terms you should know, and what you need to get started in this forex trading business. Are you getting my point right now? So let's continue. What is forex trading? For those of you who don't know, forex trading is the process of exchanging one currency from another. For example, buying the euro while selling the USD. Currencies are always traded in pairs, such as Euro USD, GBP JPY, or USD NGN, which means Nigerian Naira. The first currency is called the base currency, and the second currency is called the quote currency. If Euro USD pair is traded at 1.1000, that means 1 euro is equal to $1. When traders believe the euro will strengthen against dollar, they buy the pair, and if they believe the euro will weaken against the pair, they sell the pair. So in summary, what this is trying to say that is the foreign exchange is the process of buying and selling of foreign currencies, and we have so many currency pairs ranging from the euro, the GBP, the AUD, and so many other pairs. You understand? So let's continue for you to understand more and more of these very topics that we are breaking down today for you. How the forex market works. So in so many businesses, every business have its own procedures and have how it works so as to in forex trading. So unlike the stock market, forex trading doesn't take time. Forex trading doesn't take place on a centralized exchange. Understand? Instead, it operates 24 hours a day, 5 days a week across different financial centers around the world, from London to New York, Tokyo, and Sydney. Are you getting my point right now? Stock markets have a standardized exchange. For example, stock market in the US is called New York Stock Exchange. Understand? Stock market in Nigeria is called Nigerian Stock Exchange. Stock market in Germany is called Germany Stock Exchange. So every country have their stock exchange and it is centralized in their country. But forex market is decentralized. You understand? Forex market is decentralized. Understand? So that is why it is very big and it is very different from the stock market. So let's continue. The global decentralized structure makes forex one of the most accessible markets for traders of all levels. That is what I was saying before. The forex market is decentralized. Here are the quick look at the 4 major trading sessions. If you haven't known this, we have 4 major trading sessions in forex trading. So in the next slide, you will know the 4 major sessions that we have in the forex market. Let's continue. Number 1 is Sydney session. Sydney session is it opens the market week. Yes, of course. Sydney session opens the market week. Then we have Tokyo session. It is the Asian market activity. We have London session, which is major European trading. Then we have New York session, which is North American market action. So when action overlap, particularly London and New York, market volatility and trading opportunity tend to increase. So what this thing is trying to say that in market overlap, we have both the London and the New York session that comes together and that are very high liquidity market during those periods. So many traders tend to make profit during those periods. So it is advisable as a trader and as a beginner to trade during the volatile market. Understand? Trade when there is high volatility in the market. Trade when there is high money flowing in the market. Don't trade when there is low volatility or when the market is slow. Understand? So you'll be trading between the London and the New York session because this is the best time for you to trade the forex market. At least make a decent profit. Not that you can make profit in another session, no, but this is the best time for you to make and maximize your profit. Are you getting my point right now? Let's continue. Why trade forex? Forex trading attracts millions of traders worldwide, from large institutions to individual investors, for several key reasons. Understand? So you need to know the reason why forex trading is very good. Understand? Because every business, before you venture into any business, you need to know why and the reason why you want to do this business. So as the forex trading, you need to know why you want to start forex trading business. Number 1 is high liquidity. High liquidity. You can enter or exit trade easily due to a large number of participants. Number 2, 24 hours market. Trade any time of the day depending on your schedule. Number 3, leverage. With small capital, you can control larger position, but be caution, leverage can amplify both profits and losses. Number 4, global market. Trade major currencies like USD, Euro, GBP, and JPY, or explore exotic pair linked to emerging economies. So what this thing is trying to say that there are four reasons why people trade forex. Number 1 is because of the high liquidity. Number 2 is because of it is a 24 hours, 5 days in a week market. Number 3 is because of leverage. Number 4 is because it is a global market. You can trade market anywhere in the world. So let's continue. Essential forex term you must know. So you must know the essential forex term as a beginner who is trying to start trading the forex market. You must know and understand these essential terms that I'm about to list for you in this next slide of my video. Before placing your first trade, it is crucial to understand the common language of forex traders. And here are a few must know terms. Understand? You must know this as someone who is venturing into this business. You must know this common language of forex traders. Let me continue. Number 1 term is pips, which means the smallest price move a currency pair can make, usually between 0.001. Then we have lot, meaning the size of a trade. A standard of lot equals 100,000 units of the base currency. Then we have leverage, meaning the ability to trade larger amounts with small deposit. Then we have spread, meaning the difference between the bid, which is selling, and ask, which is buying price. Then we have margin, meaning the money required in your account to open a leverage trade. Then we have bid or ask price. The bid is the price to sell, while the ask price is the price to buy. So then in my subsequent slide, I will break everything down for you. But let's continue. You have the major currency pairs. I get my point now. The major currency pairs. The major currency pairs are those currency pairs that are highly traded in the forex market. Understand? So we have the major currency pairs, which is highly traded in the forex, which is highly traded in the foreign exchange market. So forex pairs are divided into 3 categories. Understand? For those of you watching for the first time, forex pairs are divided into 3 categories. Number 1, the major pairs. Always include the USD. For example, Euro USD, GBP USD, and USD JPY. So anytime you see a major pair, it is always included with USD. Then number 2, minor pair. Exclude the USD. When you see a minor pair, you know that it is not being traded against the USD. For example, we have the Euro GBP, we have the AUD NZD. Then we have exotic pairs. Combine a major currency pairs with one from emerging currency with the one with in an emerging economy. So it means you are trading the major currency pair against a developing country's currency. For example, the USD Nigerian Naira and the Euro Turkish Lira. Are you getting my points right now? Let's continue. How to start forex trading. So you need to learn how to start forex trading. What you need to understand before venturing and diving into the business of forex trading, because forex trading is the business of understanding and making sure that you don't miss any of the topics needed for you to succeed in the business. So getting started in forex is easier than many people think. Here are the step-by-step guide for you to follow. Number 1, learn the basics. Yes, of course. Number 1, you need to learn the basics. Understand how market works, terminology and strategy, which is what you are already doing right now. So that is why I'm here to break everything down for you. You need to understand how market works, its terminology and strategy. Number 2, choose a reliable broker. Very, very important. You need to choose a reliable broker by pick a regulated broker with a user-friendly trading platform like MT4 or MT5. It is very, very important. You need to pick and choose a reputable broker and a reliable broker that won't steal your money and go. So you need to make your research very well before choosing a reliable broker. As for me personally, the broker that I'm using is XNES and Deriv. These brokers are highly regulated and they are legit. So you can choose any of the brokerage firm that you want to trade, but make sure you make your inquiry very, very well to avoid being scam of your hard-earned money, because there are many scam brokers out there. So you need to be very, very careful when choosing your brokerage firm. Number 3, open a demo account. By this I mean practice trading with visual money to build confidence. Are you getting my point right now? Number 4, develop a trading strategy. When I mean a trading strategy, you need to decide when to enter and exit trade using technical or fundamental analysis. So in my subsequent video episode, I will break everything down for you on technical analysis and fundamental analysis. But right now, I'm still in episode 2. Let's continue. Number 5, start small. Begin with small capital and manage your risk carefully. It is very, very important. Number 6, keep learning. Also, of course, the forex market is dynamic. Continuous education is the key to long-term success. Yes, of course, you need to be a long life learner, so as in forex trading, because forex trading is the journey of marathon and not a sprint. Are you getting my point right now? Let's continue. Common mistakes beginners should avoid. As a beginner who is trying to venture into the business of forex trading, here are the common mistakes you need to avoid. It is very, very important, because so many beginners make this mistake in their trading journey. So number 1 is this thing: over leveraging. Using too much leverage can wipe out your account quickly. Yes, of course, for those of you who doesn't know what is leverage, it is a money that is being loaned to you by a broker for you to trade a higher position amount of money. Number 2, trading without a plan. Let me break it down for you. This thing is more like you are going to school, but you don't have a plan, you don't have a timetable that you read. You understand? So you need to have a plan. So as to business, a business that doesn't have a plan is bound to fail. So same as trading, once you are trading without a plan, there is a problem with you as a beginner. So always have a clear entry and entry strategy. So you need to have a clear entry and exit strategy in the market. Number 3, ignoring risk management. So many traders ignore risk management, but as a beginner, make sure that you don't ignore your risk management. Never risk more than you can afford to lose. It is very, very important, because forex is a very high liquid market. Understand? Number 4, emotional trading. Avoid making decisions based on fear and greed. It is very, very important. Avoid making decisions based on fear and greed, because so many people are emotional and they carry that emotion into trading. Please always be neutral whenever you are in trading. Make sure that you're always neutral whenever you are in trading. Are you getting my point right now? Let's continue. In conclusion of this part 1, forex trading is one of the most exciting financial markets in the world, offering endless opportunity to learn, grow, and earn. While the potential of profit is high, success requires discipline, education, and patience. By mastering this forex basics, you're really setting a strong foundation for your journey. Remember, every successful trader started as a beginner, just like you. Stay curious, keep learning, and never stop improving your strategy. It is very, very important. Now, let me go over to the next slide by telling you the currency pair that I have already told you before. Let me explain and break everything down for you. Are you getting my point right now? So, currency pairs, which I'm about to explain right now, which is the major, minor, and exotic currency pairs. In this introduction, if you have ever traded or even looked into the forex market, you have probably heard the term like major pairs, minor pairs, and exotic pairs. These are the backbone of forex trading, the currencies you buy and sell to make a profit. But what exactly do these terms mean, and why do they matter to traders? In this very guide, I will break everything down you need to know about currency pairs, how they really categorize, and what makes each type unique. Understand? Let's continue. What are currency pairs? In the foreign exchange market or forex, currencies are always traded in pairs. This is because when you trade forex, You are simultaneously buying one currency and selling the other. For example, when you see Euro USD is equals to one is selling at one, or is selling or buying at 1.100, it means that 1 euro is worth $1.10. Understand? $1.10 USD. If you believe the euro will rise against the dollar, you buy the pair to go long, which is buy. And if you believe the euro will fall against the dollar, then you sell the pair to go short. Are you getting my point? So this thing is basically means that currency pairs or forex markets are being traded in currency and is being paired together. We have so many currency pairs. So if you are buying a particular pair, you are buying that particular pair, is either that the pair will go up or the pair will go down. Because these are the two basic things that we do in the market. We buy and we sell. So in the forex market, what we do is to buy and what we do is to sell. So you are in the business of buying and selling. Understand? So each currency pair represents the exchange rate between two different nations. For example, the exchange rate of naira and the exchange rate of dollar are not the same thing. Understand? So let me give you for example. For you to exchange your dollar to naira, you need to have a particular rate amount for you to exchange your dollar to naira. As of today, 1 naira to dollar is equals to 1,480 naira. So for you to get $1 right now, you need to have 1,480 naira for you to get $1 if you're in Nigeria. I'm just giving you an example. Are you getting my point right now? So let's continue. The structure of a currency pair. A currency pair consists of two parts. Base currency, which is the first currency in the pair. For example, euro in euro USD. Host currency, the second currency in the pair. Example, USD in euro USD. Understand? So whenever you see the first currency in any pair, that first currency is the base currency. And whenever you see the second currency in any pair, that currency is the quote currency. So if the euro USD is equals to 1.100, it means 1 euro is equals to $1.10. That is basically what it means. So for you to get $1, for you to get one euro, you need to pay $1.10 for you to get 1 euro. That is basically what this thing is saying. That is why I give you the example. For you to get $1 right now in naira, you have to pay 1,480 naira for you to get just $1 in naira. Are you getting my point right now? So let's continue. If the exchange goes up to 1.1200, then the euro has strengthened against the dollar. If it falls to 1.0800, then the euro has weakened. Types of currency pairs. So in this slide, I'm going to be telling you types of currency pair, and then I'm going to be breaking all of them down for you, which I have told you in previous slide. Forex traders categorize currency pairs into three main groups: major currency pairs, minor currency pairs, and exotic currency pairs. Each group has its own characteristics in terms of volatility, liquidity, and trading volume. Let's explore them in details. Major currency pairs. Major pairs are the most traded and most liquid currency pairs in the world. They always include the US dollar, which serves as the global reserve currency. These pairs are popular among both beginners and professionals because they have tight spread, high trading volume, and low volatility compared to other pairs. Are you getting my point? So these major currency pair are the most traded currency in the forex market. So as a beginner, you need to start from the major currency, because both beginners and professionals are mainly trading the major currency pair in the market. So not just like that, those currency pairs, there are a list of them, and I will be showing you to you in the next slide, because there are 7 major currency pairs. Understand? So there are 7 major currency pairs. Number 1, euro USD. which is basically marked as euro/USD. In this description, it is most traded currency in the pair in the world. Yes, because euro USD is the most traded currency pair in the world. Then we have GBP USD, which is British pounds US dollar, also known as cable, very volatile and liquid. Then we have USD JPY, meaning US dollars versus Japanese yen, popular for carry trades, very active in Asia. Then we have, when I mean very active in Asia, I mean very active in Asia session. Then we have USD chef, which means US dollar versus Swiss francs, considered as a safe haven pair. Then we have USD card, meaning US dollar Canadian dollar, known as loonie, often influenced by oil prices. Then you have AUD USD, meaning Australian dollar US dollar, and it is being correlated with gold and commodity markets. Then we have NZD USD, meaning New Zealand dollar versus US dollar, often driven by agriculture and dairy exports. Are you getting my point right now? So these 7 currency pairs are the major currency pairs that you have in the market. So you need to write them out. The Euro USD, the GBP USD, USD JPY, USD chef, USD CAD, AUD USD, and New Zealand dollar USD. Are you getting my point right now? Why trade major pairs? You'll be asking, why am I trading these major pairs? Yes, of course. I will give you the reason why you must trade the major pairs. Number 1, high liquidity, because it is easy to enter and exit trade. That is number 1. Number 2, low spread, lower trading cost. It costs you lower trading cost because the commission that your broker will charge you for them to execute this trade is very, very low to compare the exotic currency. Then number 3, access to reliable data analytics. There are so much data and reliable data analysis for you to hop on and analyze on those pairs, because it have so many data and history. Number 4, predictable price behavior compared to exotic pairs. So it has a predictable price behavior compared to exotic pairs, because it have already have a track record of how it moves over time, because they normally say that history repeats itself, so as to these major currency pairs. Are you getting my point right now? So let's continue, which is number 2, minor currency pairs. Minor currency pairs, also known as cross pairs, do not include the US dollar. Instead, they consist of other major global currencies such as the euro, British pounds, and Japanese yen. For example, Euro GBP is the exchange rate between the euro and the Great British pounds. Example of the minor currency. I'm going to be showing you the examples of minor currency in this very slide, because we have different minor currencies so as major currency. But right now we are in minor currency. Number 1 is Euro GBP, which is the Euro British pounds. We have Euro JPY, which is Euro Japanese yen. We have GBP JPY, which is British pounds Japanese yen. We have AUD JPY, which is Australian dollar Japanese yen. We have chef JPY, which is Swiss francs Japanese yen. We have NZD JPY, which is New Zealand dollar Japanese yen. And we have Euro chef, which is Euro Swiss franc. Then you'll be asking yourself, what are the key features of minor currencies? Because this minor currency, they have key features. Let me give you, and let me break it down for you in the next slide. Number 1 is moderate liquidity compared to major currency. So there are moderate liquidity in the market in minor currency pair compared to major currency. Number 2, wider spread. So when I mean wider spread, it means slightly higher trading cost. So it have a slightly higher trading cost to compare the major currency. Major currency have a very low trading cost, why the minor currency have a slightly higher trading cost. Number 3, affected by regional economic event. So it is being affected by regional economic event, for example, European Central Bank or Bank of Japan decisions. So mainly this currency pair is being affected by European Central Bank or Bank of Japan decisions. Number 4, offer diversification away from the US dollars. It offer diversification of other it offer diversification of trading away from the US dollars. So you can trade these pairs if you don't want to trade the US dollar pairs. This is basically what this thing is saying, you understand? So why trade minor pairs? So you're asking, why should I trade minor pairs? Traders often turn to minor pairs when they want to profit from movement between other strong economies without depending on the US dollar performance. Are you getting my point? So some traders want to trade the minor pairs because they want to profit from the movement of other strong economies without eventually depending on the US dollar only. Understand? So that is the reason why some traders trade the minor pairs. Then let's continue with number 3. Exotic pairs. Which are exotic currency pairs? Exotic pairs combine one major currency like the USD or Euro with a currency from emerging or smaller economy like Nigeria, Turkey or Thailand. So it is basically saying that exotic currency is trading of currency with from the Euro or from USD combined to a developing country's economic currency like the Nigerian naira, the Turkish lira, the Thailand money and the South African rand and other currency pairs. Are you getting my point right now? So these pairs are less traded in the forex market. So these exotic pairs, they are less traded in the forex market and can be riskier, but they can also offer high volatility, meaning larger potential profit and loss. Understand? So this pair, it can be traded, but they are riskier, but they are also offer high volatility, meaning they offer larger potential profit and loss in the market. Are you getting my point right now? Let's continue. Examples of exotic currency pairs. So we have so many examples of exotic currency pair, which I'm about to show you in the next slide. Number 1 is USDTRY, which means the US dollar against the Turkish lira. We have the USD ZAR, which means US dollar South African rand. Then we have USD SDG, which means the US dollar against the Singapore dollar. Then we have the USD NGN, which is the US dollar against the Nigerian naira. Then we have Euro versus SEK, meaning Euro against the Swedish crown. Then we have the USD HKD, which means US dollar against the Hong Kong dollar. So all these pairs are the exotic currency pairs. But you need to ask yourself, what are the characteristics of exotic pairs? Understand? So what defines exotic pairs? Let me tell you the reason why these things are exotic pairs. Number 1 is low liquidity. Low liquidity. Fewer buyers and sellers in the market. So there are not too much buyers and sellers in this very exotic pair because not all people or all traders are trading the exotic pairs. Number 2, wider spread. There is always a wider spread because these places, they are high trading costs. Broker charges high when you are trading exotic currency pairs because few people don't trade, because only few people trade it. Many people are focused on the majors. Number 3, high volatility. Sharp price swing. So there is always a sharp price swing in these exotic pairs. Then number 4, influenced by local politics, economy and commodities. So this exotic pairs is being influenced by local politics, economy and commodities. Understand? Then you'll be asking yourself, why trade the exotic pairs? So you ask yourself, why should you be trading the exotic pairs? So here are the reasons why you should be trading the exotic pairs. Number 1 is potential for large profit due to volatility. Understand? Potential for large profit due to volatility. Number 2 is opportunity to diversify your trading portfolio, which is number 2. Then number 3, ideal for experienced trader who can handle higher risk. Are you getting my point? So this very exotic pair is ideal for traders who can handle and manage their risk. So if you are not experienced trader, please don't venture into the exotic currency. Only focus on the major currency, then minor. But I advise you to focus on the major currency as a beginner who is starting out this business. Now, major currency versus minor versus exotics, quick comparison. So I drew a table where I show you the major currency, the minor currency, the exotics, and now I'm giving you the quick comparison between them. Number one, any pair that includes the major currency, it must include the US dollar, and that is the major pairs. Minor pair does not include the US dollar, and exotic pair usually includes the US dollar. Liquidity, there is a very high liquidity in major currency, there is a very moderate liquidity in minor currency, and there is low liquidity in exotic currency. Then volatility, there is low to moderate volatility in major currency, and there is moderate volatility in minor currency, and there is a high volatility in exotic currency. Then spread, there is always a tight spread in major currency, and there is a moderate spread in minor currency, and there is a wide spread in exotic currency. Then best for, who are these currency best for? Number one, major currency is best meant for beginners and all traders. Then minor currency is best for intermediate traders. The exotic currency pair are best for experienced trader. So if you haven't get any experience as a trader, don't jump into the exotic currency pair. Only focus on focus on major pairs and minor pairs. You understand? It's very, very important. Then let's continue with tips for choosing the right currency pairs, because you need to know the tips and what you need to know when choosing the right currency pair. Number one, start with major currency pair. They are very stable, liquid, and ideal for beginners. So I will always advise you to start with the major currency pair because they are very stable, they are highly liquid, and they are ideal for beginners and also experienced trader. Number two, understand the economics behind every pair. So you need to keep track of news, interest rates, and GDP report. It is very, very important for you to keep track of those news, economic activities of the major currency pairs and their GDP reports. Number three, watch correlation. Some pairs move in the same direction like Euro USD and GBP USD, while others move opposite like USD Chef and Euro USD. Number four, manage risk. Exotic pairs can move fast, so always use stop loss and proper position sizing. Are you hearing me? You need to always put your stop loss and proper position sizing if you are trading the exotic currency pair. So in this conclusion of chapter, or in this conclusion of this second slide, you need to understanding currency pair is the foundation of forex trading. Whether you trade major for stability, minor for diversity, or exotics for excitement, each category offers its own advantage and challenges. The key is to know how each pair behave, manage your risk wisely, and trade based on solid market analysis, not your emotion. Start small, stay consistent, and let your knowledge grow with every trade. Remember, mastering the art of trading begins with mastering the basics, and currency pair are the perfect place to start. Understand? So right now, let me move to the next slide, which is base currency versus cross currency. Understanding the core of forex trading. Understand? If you really new to forex trading, one of the first thing you will notice that currencies are always written in pairs, like the Euro USD, GBP USD, and the USD NGN, which is USD Nigerian Naira. Both have you ever understand? Both have you ever wondered why they are displayed that way and what each part of those pair represent? That is why the concept of base currency and core currency comes in. These two terms form the foundation of how every foreign exchange transaction works. In this video, you will learn what base and core currency are, how they work, and how they work together, and how understanding them can help you make smarter trading decisions. Understand? Let's continue. What is forex currency? What is a forex currency? Forex currency pairs. In the forex market, currencies are always traded in pairs because you are simultaneously buying one currency and selling another. For example, when you see the currency pair Euro USD, it represents the exchange rate between the euro and the US dollar. If the Euro USD is 1.10, that means 1 euro is equals to 1.10 US dollar. This pairing system allows traders to speculate on whether one currency will strengthen or weaken relative to another. So what is the base currency? The base currency is the first currency listed in the currency pair. It represents the unit of currency you are buying or selling. Think of it as the primary currency in the trade, the one you are comparing against another. For example, in the pair Euro USD, the euro is the first currency, which is the base currency, and the US dollar is the core currency, which is the second currency. If the Euro USD is 1.10, it means 1 euro, the base currency, equals to 1.10 US dollar, the core currency. So if you buy the Euro USD, you're really buying the euro and selling the dollar. If you sell the Euro USD, you're really selling the euro and buying the dollar. What is the core currency? The core currency is also called the counter currency. It is the second currency in a currency pair. It shows how much of that currency is needed to buy 1 unit of the base currency. Continue our example of Euro USD, which is equals to 1.100. The core currency is the US dollar. It means that you need $1.10 to buy 1 euro. So the core currency essentially measures the value of the base currency. Then you need to ask yourself how to read currency pairs. Understand? Let me break it down for you in step by step with an example. Euro USD equals 1.100. Base currency euro, the currency you really buying or selling. Core currency, which is the USD, the currency used to price the base. Exchange rate is 1.100. The amount of quote currency, the USD, needed to buy 1 unit of the euro, which is the base currency. If the rate increases from 1.100 to 1.1200, that means the euros has strengthened against the dollar. If it falls from 1.100 to 1.0800, the euro has weakened against the dollar. Example, understanding through real market scenario. Let's look at these two practical examples. If 1 euro USD equals 1.100, you buy euro USD and you expect the euro to rise against the dollar. You sell the euro USD, you expect the euro to fall against the dollar. If the price rises to 1.1200, your buy trade gains value because the euro has appreciated. Let me give you the second example. If USD JPY is equals to 150.00, that means $1 equals to 150 Japanese yen. The base currency is the US dollar and the core currency is Japanese yen. If the rate rises to 152.00, the dollar is stronger because you now buy more yen. If it falls to 148.00, the dollar is weaker because it now buys fewer yen. Are you getting my point right now? Then you ask yourself why base and core currency matter in the forex market. You need to understand it very well. Understanding the difference between base and core currencies is crucial for several reasons. Number 1, direction of your trade. You must know which currency you are buying or selling to make the right decision. Example, Euro USD. Euro USD buying means going long on euro and short on the dollar. Number 2, profit and loss calculation. The core currency determines how your profit or loss is calculated. For instance, if you trade Euro US dollar, your profit or loss is measured in US dollar. Are you getting my point right now? Number 3, analyzing the market. News or economic data can affect one currency in any pair more than any other. Understanding which one helps you interpret price movement correctly. Number 4, cross-pair trades. When trading pairs that doesn't involve the US dollar, the Euro GBP or AUD JPY, knowing which is base and which one is quote helps you manage your exposure to different economies. Are you getting? Then base currency and quote currency notation rule, because base currency and quote currency have its own notation rule. Understand? While most currency pairs follow standard notation convention, here are a few guidelines you need to know. Number 1, the base currency is generally the stronger or more stable of the two. Historically, the order of currency symbol follow market convention. For example, Euro USD, Euro before the dollar; GBP USD, British pounds before the dollar; USD JPY, dollar before the yen. The US dollar is often the base currency, except when paired to euro, pounds, or Australian dollar. Pro tips: how to remember the differences. I'm going to be giving you this pro tip right now. You need to know how to remember the differences. Here is an easy way to remember. Base currency equals to buy, quote currency equals to quantity. That means the base is what you're really buying or selling. Then the quote tells you how much you need to pay in order to buy the base currency. Are you getting my point right now? Let me break it down again. The base is what you are buying or selling. The quote tells you how much you need to pay in another currency to get it. Example, Euro USD equals to 1.100. You need 1.10 USD to buy 1 euro. Then let's continue. Base currency and quote currency table example. You have the currency pair, you have the base currency, you have the quote currency, and you have its meaning. So Euro USD, which is the base is the euro and the quote one is euro. Then meaning 1 euro equals to how many amount of US dollar you want to purchase. Then GBP JPY, which is the British pounds JPY, which means 1 GBP, 1 pounds, is equals to how many JPY you need to purchase. USD chef, which means USD dollar, which is Swiss francs, means 1 US dollar is equals to how many amount of chef. AUD USD, which means Australian dollar versus US dollar, which means 1 AUD will cost you how many US dollar. Then USD versus Nigerian naira, meaning 1 US dollar will cost you 1,480 naira as of today. So this is the breakdown for you to understand what the base currency and the quote currency is talking about, so that you don't get confused. You understand? Then let's continue. In conclusion, the concept of base currency and quote currency might seem simple at first, but they are the foundation of everything in forex trading. Understanding how they work helps you interpret exchange rate correctly, plan your trade with confidence, and manage your risk effectively. It is very, very important. Then in short, the base currency is what you're really buying or selling. Then the quote currency tells you how much it costs. Master these bases and you will be one step closer to becoming a smart and informed trader. Are you getting my point right now? It is very, very important to master these bases, because once you miss the bases, definitely you are bound to fail. So you need to understand the basis very, very well. Are you getting my point right now? Then let's move to bid, ask, and spread in forex. A simple guide for beginner. So you need to understand the bid, ask, and spread in forex. If you have ever looked at a forex trading platform, you have probably noticed two prices next to every currency pair, which is the bid and the ask, and the right between them lies something called the spread. Understanding these three terms is essential for every trader because they really directly affect how much profit or loss you make in every trade. Are you getting my point right now? So in this very video, I will break down what the bid, ask, and spread meaning in simple terms, how they work and why they matter to your forex trading success. What are bid? What are asks? And what are spread? In forex trading, currency pairs are quoted in pairs, Euro, USD, or JPY, and every pair have its own price. Are you getting my point right now? The bid price is what buyers are willing to buy or what buyers are willing to pay. Then the ask price is what sellers are asking for. Then the spread is the difference between the two prices. Then let's explore each of them in details. What is the bid price? Which is number one. The bid price is the maximum price a buyer is willing to pay for a currency pair in trading terms. It is the price at which you can sell a currency pair. Let me give another example. If the Euro US dollar is quoted in 1.1050 slash 1.1052, the bid price is 1.1050. That means if you are really selling the pair, opening a short position, you are selling at 1.1050. Think of it this way: bid equals to price you sell at. Then number two, the ask price. The ask price, also called the offer price, is the minimum price the seller is willing to accept. Understand? In trading terms, it is the price at which you can buy a currency pair. Using the same example, Euro USD equals 1.1050 slash 1.1552. The ask price is 1.1052. That means you're really buying the pair. Opening a long position, you will buy at 1.1052. Think of it this way: ask equals to price you are buying at. So the ask is the price that you are buying at, and the bid is the price that you are selling at. Are you getting my point right now? Let's continue with number three, the spread. The spread is the difference between the bid and the ask price. It represents the cost of trading, the smaller fee you pay to your broker for executing the trade. So necessarily, the spread is the difference between the bid and ask. It is what your broker charges you, or the commission that broker collects from you for executing those trades for you. Using our earlier example, if the bid is 1.1050, the ask is 1.152, then the spread is equals to ask minus bid. When you minus these two numbers, it will give you 0.002, which is 2 pips. So your broker is charging you 2 pips difference in your spread. Understand? Think of it this way: spread equals to the broker's hidden commission. How the spread works in forex markets? So you need to understand how the spread works in the forex market so that you don't get confused when you start trading. When you enter a trade, you immediately start with a small unrealized losses. That is the spread. Here is why. When you buy, you enter at the ask price, but if you sell immediately, you will do so at the bid price, which is slightly lower. The differences between these two prices, the spread is your transaction cost. So to make a profit, the market needs to move in your favor by more than that spread. For example, if the spread of the US dollar is 2 pips and you open a buy trade, the price must rise by at least 2 pips for you to break even. Are you getting my point right now? Let me record it again. If the spread of a US dollar is 2 pips and you open a buy trade, the price must rise by at least 2 pips for you to break even. Why the spread exists? So you'll be asking yourself, why is this spread in existence? Let me break it down for you. Forex brokers make money by charging spread instead of, or in addition to, commission. The spread covers it. Understand? So instead of them to charge you off from your profit, then they charge you through your spread. Then your spread covers the transaction, which means it covers the transaction processing, market liquidity, and the forex broker profit. So these are the reasons why the spread exists. It covers the transaction processing, the market liquidity, and the broker's profit. Let me give another instance. The tighter, smaller the spread, the lower your trading cost, and the better it is for you as a trader. Types of spread. There are many types of spread in the forex market. So many YouTubers who are teaching this course won't tell you there are many types of spread, but there are many types of spread in the forex trading. Let's break it down for you. Number one is a fixed spread. Let me break down for you. The difference between the bid and ask stays the same regardless of the market volatility. Understand? Common with market makers brokers. Best for beginners who want predictable cost. Example: a fixed 3 pips spread on Euro USD means the spread remains 3 pips at all times. 2. Variable or floating spread. The spread changes depending on the market condition and volatility. These are common with ECN broker, which means electronic communication network, or SCP, straight through processing brokers. Because we have different type of broker, we have the ECN and SCP brokers. Spread can widen during high volatility or news event. So this fixed spread, they have a fixed spread for each pairs, but this variable or floating spread, the spread is not fixed. They only tighten or widen the spread based on market condition. Are you getting my point? Or when the market is high volatility, or when there is a news event. Are you getting my point right now? Let's continue. Example: Euro USD spread might be 1 pips in calm market, but widen to 5 pips during major news or release event. Factors that affect the spread, because there are so many factors that affect the spread. Several factors determine how wide or tight a spread can be. Number one, market liquidity. Major pairs like Euro USD have tight spread than exotic pairs like USD South African rand, because they are really more traded frequently. Understand? Yes, because major currency pairs are being traded every time, so it will have a tight spread more than the exotic pairs. For example, the US dollar South African rand, because they really trade them more frequently. Then market volatility, which is number two. During high impact news like non-farm payroll or interest rate decision, spread can widen significantly. Number three, time of day. Spread are usually tighter during London and New York session, when trading volume is highest, and wider during quiet session. Number four, brokers type. ECM broker generally offer low spread than traditional market makers. Why? Why bid, ask, and spread matters in the forex market. So you need to ask yourself, why is the bid, ask, and spread matter to traders? It is very, very important. Understanding these three concepts is the key to trading smartly, and here is why they matter. Number one, they determine your cost. So the spread is a built-in cost that affects every trade. Tighter spread means cheaper trading. They affect entry and exit price, which is number two. Knowing the bid and ask helps you understand the price you will buy or sell at. Number three, they help you choose a broker. Comparing spread between broker helps you pick one that is fair and transparent. Number four, they impact scalping and day trading. Short-term traders rely on small price movement, so wide spread can eat into profit. Example: let's recap by putting all of them together. Let's choose a real world example with pair like GBP USD trading at 12550 and 12553. Let's use the term, the meaning and value. Bid price, price at which you are selling at, and the value is 1.250. The ask price, which is the price that you are buying at, which is 1.253. Then the spread, which is the difference between the two, is 0.003, which is 3 pips. How do you get this spread? When you minus this 1.250 from 1.253, you get 3 pips. Are you getting my point now? So if you buy the Euro USD, your trade starts at 1.253. To make a profit, the market must move at least 3 pips higher before you can break even. Are you getting my point right now? Yes. To make a profit, the market must move at least 3 pips higher before you can break even the trade. Are you getting my point right now? Tips to minimize spread cost. So I'm going to be telling you the tips for you to minimize spread cost. Number 1, trade during high volatility market. Yes, of course. Focus on the London and New York session for a tighter spread. That is number 1 tips. Number 2, choose a low spread broker. It is very, very important. Compare spread before opening an account. Even small difference matters in long term. It is very, very important. Number 3, avoid trading during major news release. Spread often widen dramatically during higher volatility events. Number 4, trade major pairs. Pairs like Euro USD and USD JPY have tighter spread than exotic pairs. So in the conclusion, understanding bid, ask and spread is one of the most important steps in becoming a smart forex trader. The bid is the price, is what a buyer are willing to pay, meaning you are selling at this price. Then the ask price is what seller are asking, meaning you are buying at this price. The spread is the differences, which means your cost of entering a trade. This concept is very, very important. You need to master this concept, and you will not only understand how forex market works, but also learn how to manage your trading costs and improve your profitability. Every successful trader started from mastering this basis, and now you can do it. So you need to master this very, very important before you venture into trading, to avoid mistake, because once you miss the basis, you have already missed everything. That is why I'm taking my time to explain everything for you from step by step, one after the other. Then let's switch over to another slide of topic: pips, pipettes and points in forex, understanding the language of price movement. So let's continue right now. If you have ever looked at the forex price chart, you have seen numbers that move up and down, sometimes very small amounts. This tiny movement might seem insignificant, but they can make a big differences in your profit or loss. In forex trading, small price changes are measured using pips and pipettes and points. Understanding these 3 terms is crucial for reading charts and calculating profits and managing risk effectively. So in this very slide, I will break down what they mean, how they calculate, and why they matters to every trader, especially beginners. So what is a pip in forex? A pip stands for percentage in point, or price interest point. It is standard unit of measurement for price movement in the forex. A pip is usually the smallest whole price change that occur in a currency pair. For most currency pair, 1 pip equals 1.0001. That is 1 of the 10,000 of a unit. Example: if the Euro USD moves from 1.1050 to 1.1051, it has moved by 1 pip. However, not all currency pairs use the same decimal places. Pair involving the Japanese yen, 1 pip is equals to 0.01 because Japanese yen is quoted in 2 decimal places. Example: if the USD JPY move from 150 to 150.001, it is a movement of 1 pip. In short, most pairs have 1 pip, which is equal to 0.001, while yen pairs have 1 pip, which is 0.01. And you'll be asking yourself, why pips are important? Yes, pips help traders in these following ways. Number one, measure price changes in the market, calculate profit and loss, define stop loss and take profit level, and manage risk per trade. So pips helps you in these following ways that I've already tell you. Measures your changes in the market, calculate your profit and loss, define your stop loss and take profit, and manage your risk per trade. They are the universal language of price movement, allowing traders trade worldwide to communicate changes clearly and consistently. Then, what is a pipette? A pipette is a 1/10 of a pip. It represents an even smaller measurement of price movement. In the modern forex platform, many brokers quote prices with 5 decimal places for most pairs or 3 decimal places for yen pairs. That extra digit is the pipette. For example, if the Euro USD price move from 1.10556 to 1.1057, that is 1 pipette or 0.1 pip. Example, if the price of USD JPY move from 150.005 to 150.006, it is also 1 pipette. In small term, 1 pipette equals to 0.1 pip. So 10 pipettes equals to 1 pip. Pipette gives traders greater accuracy when measuring price movement, especially for higher accuracy traders or scalpers who depends on small price changes. What is the point in forex? In forex, the term point can also sometimes cause confusion because its meaning depends on context. Traditionally, in forex, a point is the same as a pip, a single unit of movement in the 4th decimal place or the 2nd decimal for yen pairs. However, in other financial markets like stock or indices, a point can represent a different numerical value, such as $1 full or 1 unit change in the index. To avoid confusion, most forex traders use the term pip instead of point when referring to price movement. So, pip, pipette, and points in action. Let's make this thing clearer with some practical example, because I would like to give you an example. If you have noticed, in all my teaching, I always give you example for you not to be confused and for you not to be carried away. Example: Euro USD as usual. If price moves from 1.0 if price move from 1.1050 to 1.1065, the difference is 0.0015, which is 15 pips. If your broker quotes decimal is example 1.1058 slash 1.10518, that extra digit shows pipettes. So the move might actually be 15 pips or 150 pipettes. Example 2, USD JPY. If the price move from 150.00 to 150.35, the difference is 0.35, which means 35 pips. If the broker shows 3 decimal place 150.001 slash 150.351, the 3rd decimal is the pipette. So 150.001 to 150.351 equals to 35 pips or 350 pipettes. How to calculate pip value? Because as a trader, you need to know how to calculate your pip. It is very, very important because it will help you determine your profit and loss. Because the value of a pip determines and depends on 3 things. Number 1, the currency pair being traded. Number 2, the lot size, which is your trade volume. Then the 3, the exchange rate. Are you getting my point, right? For a standard lot size, 100,000 units equals to 1 pip is equals to $10 on the most currency pairs. Example: if you buy 1 lot of Euro USD and the price move by 10 pips in your favor, then pay 10 pips by $10 per pips equals to $100, which is your profit. For a mini lot size, which is 10,000 units of the base currency, 1 pip is equals to $1. And for a micro lot size, which is the 1,000 units of the base currency, 1 pip is equals to 10 cents. This is why understanding pip is vital. Even small price move can lead to a big gain or losses depending on your lot size. Are you getting my point right now? Pips and risk management. Let's continue. Successful traders don't just focus on profit, they focus on risk. Using pips allow you to set your stop loss and take profit level clearly. Measure risk to reward ratio. Example, risking 20 pips to gain 40 pips, which is 1:2 ratio. Then keep your position size consistent. For example, if your stop loss is 30 pips and your risk is $30, then your position should be 0.1 lot, which means mini lot. This ensure each pips equals $1. Then summary in these key differences. Let's move to the term. Term, the definition, decimal value, and example using the euro US dollar. Pip, standard unit of movement 0.001. If the US dollar price is being quoted in 1.1050 to 1.1051, it equals 1 pip. Then if it is in pipettes, 1/10 of a pip, which means 0.00001, which means 1.105506, and 1.1 or 1.10507, which is 1 pipette. Point and change the same as pip depending on the context, often used in interchangeably with pip. Understand? So is it that you call it a pip or you call it a point? Are you getting my point? So that you don't get confused. Is it that you call it a pip or you call it a point? Are you getting my point right now? So let's have a quick recap. Pip is the standard measure of a price movement that is mainly measured in 0.001 or 0.01 for JBPY pairs only. Pipette is a 1/10 of a pip, extra decimal precision. Then point in another word for a pip, depending on the market. So point is another name for pip, period. Understanding this unit helps you to do what? It helps you to know this. When you're understanding this, it helps you to measure prices changes accurately, calculate profit and losses, and also manage your trading risk wisely. Mastering pips, pipette, and point is one of the first steps to becoming a confident and disciplined trader. In conclusion, in forex trading, success begins with mastering small details, and pips are the heartbeat of price movement. Knowing how to read, calculate, and manage pips, pipette, and point help you to understand the market behavior, set price trade target, control your risk, and maximize your profit. So the next time you see price move by 20 pips or 50 pips, you know exactly what that means and how it affects your trading account. Are you getting my point right now? Then let's continue from what is forex lot size being explained as standard, mini, micro, and nano lot size. When you first step into forex trading, you often hear traders saying things like, I just opened one lot position on Euro USD, or I'm trading 0.01 lot on GBP USD. At first, this might sound confusing, but what exactly is lot? And why is it important? In forex trading, a lot represents the size of your trade and how many units of a currency you are buying or selling. Understanding lot size is one of the most crucial part of becoming a successful trader because it directly affects your risk and profit and loss. Understand? In this video, we will break down everything you need to know about lot size in forex, including standard, mini, micro, and nano lot size, and how to choose the right one for your trading strategy. What is a lot in forex? A lot in forex is a standardized unit used to measure the volume or size of trade. Since currencies are traded in large quantities, brokers created standard lot size to make it easier for traders to place orders. Think of it this way: when you buy or sell currency in the forex market, you not just trading $1 or €1 at a time. You do trading a lot that represent a certain number of units. So the bigger the lot size, the greater the potential for profit or loss for each pip movement. Understand? So the higher your lot size, the higher your profit and the higher your loss. So that is basically what this thing is explaining. The bigger your lot size, the bigger your loss and the bigger your profit. Are you getting my point right now? That is why risk management is very, very important in your trading career. Understand? Let's continue. Types of forex lot size. There are four main types of forex lot size in forex trading. You have the standard lot, you have the mini lot, you have the micro lot, and we have the nano lot size. So each one represented by different number of currency units and suit different kinds of trader, from professional managing large accounts to beginners learning the ropes. Let's go over in each details. Standard lot. A standard lot is the largest common trade size in the forex market. One standard lot equals 100,000 units of the base currency. Example, if you do trading the Euro USD, one standard lot means you do trading 100,000 euro. Each pips 0.001 price movement is typically worth $10 in a standard lot for most currency pairs where the US dollar is quoted against the currency. Understand? Example, let me tell you how to calculate it. If the Euro US dollar moves from 1.1050 to 1.1050 to 1.1060, that is a 10 pip movement. Profit and loss equals to 10 pips times 10 pips equals to $100. So we should trade standard lot size. Who should trade standard lot size? Experienced traders, those with larger account balance, usually $10,000 or more. Traders comfortable with higher risk and larger price movement. Number 2, mini lot. A mini lot is 1/10 size of a standard lot. One mini lot equals to 10,000 units of the base currency. Each pip is worth approximately $1. Example, if Euro USD move by 10 pips in your favor, 10 pips by $1 equals to $10. Who should trade mini lot size? Intermediate traders, those with smaller account size from 1,000 to 5,000, traders who prefer moderate risk. Mini lot size are great balance between learning how to trade, learning how the market works, and keeping your risk manageable. Then number 3, micro lot. A micro lot is 1/10 of a mini lot and 1/100 of a standard lot. One micro lot equals to 1,000 units of the base currency. Each pair is worth approximately 10 cents. Example, if the Euro USD moves 50 pips in your favor, 50 pips times 10 cents equals to $5, which means you are making profit of $5 if it moves in 50 pips. Who should trade the micro lot size? Beginner traders, those with small account less than $1,000, traders learning how to manage emotion and testing strategies. Then micro lot size. Micro lot size are perfect for those who want to trade safely while learning how to handle real market movement. Number 4, nano lot size. A nano lot size is the smallest trade size available. One nano is equals to 100 units of the base currency, equals which each pips which approximately is 0.01, which is 1 cent. Example, if the Euro USD moved by 100 pips in your favor, 100 pips times 0.01 equals to $1. Who should trade nano lot size? Absolute beginners, traders testing a new strategy or trading system, those who want to minimize losses while gaining experience. Nano lot size are not available with all brokers, but some offer them through cent accounts or micro trading platform. Are you getting my point right now? Quick comparison table. Lot size, unit of the base currency, pip value pair and account type, and traders level. If you are making use of the standard lot, which means 100,000 units of the base currency, and which means $10 per pip movement, and it is being mainly used by a professional and experienced trader. If you are making use of mini lot size, which is the 10,000 units, you are making $1 and it is the standard mini lot size, and it's mainly used by intermediate traders. If you're making use of the micro lot size, which is 1000 units, you are making 10 cents per pip movement, and which is mainly for micro account users and for beginners. Then if you are making use of nano lot size, it is mainly for 100. It is the 100,000 units of the base. It is the 100 units of the base currencies, and it's mainly for beginners who are trading strategies, and mainly for people who are making use of nano or cent accounts. Then you need to ask yourself how lot size affects risk and profit. So you need to know and understand how lot size affects risk and profit. Lot size determines how much you gain or lose for every pip movement. If you trade a larger lot, each pip movement remains a larger dollar value, increasing both your potential profit and risk. Let's look at an example. Suppose you buy Euro USD at 1.1050 and it rises to 1.1060, which is a 10 pip movement. Lot size. If you make use of one standard lot size, that means you'll be making profit of $100 if the trade moves in your favor. If you make use of mini lot size, then you'll be making $10. If you make use of micro lot size, you'll be making $1. Then if you make use of nano lot size, it will be making 10 cents. So you can see you can quickly see the risky reward and changes depending on your lot size. So this is why proper position sizing is essential in forex trading, because so as you're making this profit, and at the same time, if it goes against you, you'll be losing the same amount of money, because lot size determines your profit and losses in the forex market. Are you getting my point right now? So choosing the right lot size. The right lot size depends on 3 key factors. Number 1, your trading account balance. Number 2, your risk tolerance. Number 3, your trading strategy. A good rule of thumb is to risk no more than 1% to 2% of your account balance on a single trade. This is the best advice I can give you. Don't risk more than 1 or 2% of your account balance on a single trading position. Let me give you an example. If you have $1,000 account and you risk 2%, your maximum loss per trade is $20. If your stop loss is 20 pips, $20 divided by 20 pips, that is 1 pip. So you should trade 0.1 lot, which is the mini lot size. This ensures that even if you lose a trade, your account still stays protected. Then I'm going to be telling you tips for beginner. Start small. Begin with micro or nano lot size until you fully understand how the market works. Number 2, focus on consistency. Small steady profits are better than risking big profits. Use demo accounts. Practice calculating lot size, pip value and risk before trading real money. Never over leverage. Big lot size with high leverage can wipe out your account quickly. Conclusion: understanding lot size is a fundamental step to becoming a skilled forex trader. Each lot size, standard, mini, micro and nano, serve as a purpose depending on your experience level, account balance and risk tolerance. Here are a quick reminder. Standard loss equals to for experienced trader seeking for high return. Mini lot size equals to for intermediate traders balancing risk and reward. Micro lot size for beginners practicing with real money. Then nano lot size for absolute beginners and low risk trading strategy testing. The key to long-term success in forex trading isn't about trading big. It is about trading smart. Choose the lot size that fits your financial goals and risk comfort, and you will build a solid foundation for consistent and confident trading. Leverage and margin in forex trading, which is the power and the risk. Then let's continue with what is leverage and margin. One of the biggest attractions of forex trading is the ability to control large positions with a small amount of capital. This is made possible through the powerful concept leverage and margin. Leverage can amplify your profits but can also magnify your losses. Margin, on other hand, is the money your broker requires you to deposit to open and maintain a leverage trade. In this video, we will break down the leverage and margin mean, how they work together, and how to use them wisely so they will become tools of opportunity and not disaster. What is leverage in Forex? Leverage allows traders to control a larger position in the market using a smaller amount of their own money. It is expressed as ratio such as 1:10, 1:50, 1:100, and even 1:500. In this ratio, this ratio tells you how many times your trading capital is multiplied to a open position. Example: if you have $1,000 in your trading account and your broker offers you 1:100 leverage, you can control a position worth $1,000 times 100, which means $100,000. This means that you can trade a full standard lot size of 100,000 units even though you have a $1,000 account in your trading account. How leverage works? Leverage is like borrowing money from your broker to increase your market exposure. So leverage is the money loaned to you by your broker. So you put down a small portion of the trade's total value called margin, and your broker covers the rest. If the market moves in your favor, your profit are magnified. But if the market goes against you, your losses are multiplied. Example: let's say you buy Euro USD at 1.1000 with 1:100 leverage using $1,000 account on your own capital. You control 100,000 units of worth of Euro USD. If the price move up by 100 pips from 1.100 and the profit of a $1,000, and 1 pip is equal to $10 per standard lot size, that is 100% return on your investment. But if the trade moves $100 pips against you, you will lose your entire $1,000 account. Lesson to learn: leverage is a double-edged sword. It can multiply your profit and your losses. Are you getting my point right now? So leverage is a double-edged sword. It can multiply your profit. At the same time, it can multiply your losses. You need to be very careful when you are using leverage. That is why you need to learn. That's why you need to learn risk management in trading. Let's continue. What is margin in Forex? Margin is the amount of money required by your broker to open and maintain a leverage trade. It is not a fee or cost. It's simply a security deposit that ensures you can cover potential losses. The margin you need depends on the leverage ratio and the size of your trade. Example: you want to open a one standard lot of 100,000 unit position on Euro USD using 1:100 leverage. Required margin is 100,000 units by 100. So you need $1,000 in your account to open that trade. If your leverage was 1:50, you will need fractional, which is $2,000. So you need $2,000 margin. So the higher the leverage, the lower the margin required. Are you getting my point right now? Understanding the margin level and margin call. When trading with leverage, it is important to monitor your margin level. A percentage that shows how much of your capital or how much of your account equity is being used as margin. Margin level formula. Example: if your account equity is $2,000 and your margin is $1,000, then fractional $2,000 minus $1,000 by 100, and it gives you a 200%. This means you still have enough free margin to open more trades or withstand losses. Then margin call. If your losses increase and your margin level drop below certain threshold, usually around 100 or lower, your broker will issue a margin call. This is warning that you must deposit more funds or close some trade to free up margin. If you fail to act, your broker may automatically close your position to prevent your account from going negative. The process is called a stop out. Leverage and margin in practice. Let's see how leverage and margin work together in a real market world example. Leverage: market size, which is the Euro USD, margin required, and effect. As you can see, 1:100, which is the 1,000 unit of the base, which is the 100,000 unit of the base currency, is $10,000. There is low risk and low exposure. 1:50 by 1,000 by one standard lot is $2,000, which is moderate risk exposure. 1:100 by 100,000 units, which is $1,000. It is a high risk and higher reward. Then 1:500 by 100,000 units of the base currency, which is $200, is extremely high risk. Higher leverage equals to small margin required a big up is equals to a big potential gain or loss. The relationship between leverage, margin, and risk. Leverage determines how much you can control in the market. Margin determines how much you need to open a position, and risk determines how much you should lose if the trade goes against you. I get my point right now. Then, if you use too much leverage, even small price movement can cause huge loss. If you use low leverage, you will have more control and can manage your risk better. Are you getting my point right now? Then, rule of the thumb: never use more leverage than your strategy and your emotion can handle. Professional traders often use 1:10 or less, even if broker offer higher ratio. Pros and cons of leverage, because leverage have advantage as disadvantage. Number one advantage is trade higher position with small capital. Number two, amplify potential profit. Number three, allows flexibility and diversification. Then disadvantage of leverage: amplify losses, can lead to margin call or account wipeout, which means that you can blow your account definitely. Then number three, encourage over trading or poor risk management. Tips of using leverage and margin call wisely. Number one, start small. Use low leverage, 1:10 or 1:20, or you gain experience. Number two, always use stop loss order. Protect your account from unexpected market move. Number three, monitor your margin level. Keep it above 200% for safety. Number four, risk only 1 or 2% of your trading account per trade. Number five, don't max out your leverage just because it is available. Don't just because it's available doesn't mean you should use it at all. Are you getting my point right now? So don't max out your leverage. In conclusion, leverage and margin are powerful tools in forex trading. They can turn small profit movement into a big opportunity. However, with great power comes great responsibility. Misusing leverage is one of the fastest way to lose your capital. By understanding how leverage and margin call works, setting realistic and risk level, and maintaining proper margin level, you will stay in control of your trading and your emotion. Remember, leverage doesn't make you rich. Discipline and strategy do. Then let's continue again on what is called liquidity and volatility in forex trading, which is the twin force that drive the market. Every trader, beginner or expert, must understand key concepts that define the heartbeat of the forex market, which is the liquidity and volatility. These two determine how easily you can enter or exit trade, how much price move, and what kind of risk and opportunity you face. In simple terms, liquidity tells you how easy is it to trade a currency pair, and volatility tells you how much price moves. Understanding both is essential for building a winning trading strategy. In this context, we will break down what liquidity and volatility mean, how they affect forex trading, and how much to use them to your advantage. What is trading liquidity in the forex? Liquidity refers to how easily a currency pair can be bought or sold without causing a significant change in its price. A higher liquidity market is one where there are many buyers and sellers, making it easy to execute trade quickly and at stable price. Example: the Euro USD pair is the most liquid currency pair in the world because it involves two of the most traded currency, the Euro and the US dollar. You can buy or sell the Euro USD at almost any time without large price fluctuation. Characteristics of higher liquidity: tight bid or ask spread, small difference between buy and sell prices, fast trade execution, stable prices, and large trading volume. Number two is trading liquidity, which is low liquidity. When there are fewer participants in the market, liquidity decreases. This means that trades can no longer be executed. Trades widen, spread widen, and prices can jump unexpectedly, especially during news release or off-market hours. Example: exotic pairs like USD Turkish lira or Euro Swedish Koran tends to have lower liquidity, meaning they are more expensive and riskier to trade. Why liquidity matters? Number one, it ensures quick execution of trade, keeps trading costs low and tight spread. Then number three, reduces the chance of slippage when you get a worse price than expected. Number four, makes price movement more predictable and stable. Then let's move ahead. What is volatility in Forex? Volatility means how much and how quickly the price of a currency pair moves within a specific period. It shows the degree of variation or fluctuation in price, and in other words, how wide or calm the market is. Example: if the Euro USD moves between 1.100 to 1.020 in a day, means 20 pips, it is low volatility. Then if GBP JPY move from 190 to 191.50, it means 150 pips, it means high volatility. High volatility means high price swing. It often occurs during major economic news release like NFP or interest rate decision, when the market sentiment changes suddenly, or in low liquidity hours where fewer traders cause big moves. While volatility While volatility creates profit opportunities, it is also increases risk, and price can move sharply against you in seconds. Are you getting my point right now? So let's continue from where we stop. Low volatility. Low volatility means stable, slower price movement. It often it is often occurred during the Asian trading session, on public holidays, when there is no major economic data. Low volatility means less risk but also fewer trading opportunity. While volatility matters, it determines potential profit and risk per trade, affects your stop loss and take profit level, helps identify the best time to trade, influence which currency pair are stable for your strategy. Then the relationship between liquidity and volatility. The relationship between liquidity and volatility. Liquidity and volatility are closely connected. When one changes, the other usually reacts. Condition, liquidity, volatility, and market behavior. The major session, New York, London overlap, have higher liquidity, moderate volatility, and smooth price movement. While the economic news release have moderate liquidity, higher volatility, and sharp, unpredictable market. Are you getting my point right now? Then late US or Asian position have low liquidity, low volatility, and slow quiet market. Then holidays or weekends have low liquidity, low volatility, and almost no movement. In short, high liquidity equals to stable price or less volatility. Then low volatility equals to bigger price jump or more volatility. For example, when the London and New York session overlap, the liquidity is at its peak, making it the best time for traders. But when the market is thin, like during the early Asian hours, liquidity drop and the price moves can be unpredictable, even volatile. How liquidity and volatility affects trading. Number one, spread cost. Higher liquidity equals to tight spread, lower trading cost, but lower liquidity equals to widespread, high trading cost. Number two, trade execution. High liquidity ensure faster, more accurate order execution, while low liquidity can cause slippage, especially with market orders. Number three, risk management. Let's talk about risk management. High liquidity requires wider stop loss and smaller position size, while low volatility allows for tighter stop but profits are usually smaller. Number four, strategy selection. Scalpers prefer high liquidity and modest volatility, while swing traders may prefer high volatility for a larger price move. Then position traders focus on long-term trend, why short-term volatility matters. Why short-term volatility matters less. Example of liquid and currency volatility pairs. We have currency pairs, liquidity, volatility, and this description. The euro US dollar have high liquidity, have moderate volatility, and most traded stable movement. The GBP US dollar have high liquidity, high volatility, and big move, popular with traders. USD will have high liquidity, moderate volatility, and steady predictable price movement. AUD have moderate liquidity, moderate volatility, and influenced by commodities. GBP will have moderate liquidity, high volatility, and nicknamed the beast due to wide spring. Then USD ZAR has low liquidity, high volatility, and exotic risky at or high spread. How to trade liquidity and volatility wisely. Trade high liquidity hours during London and New York session or overlap. Avoid trading during low liquidity period like holidays or US session. Use an economic calendar to prepare for volatility for news event. Adjust position sizing. Smaller during high volatility, larger income market. Number 5. Use stop loss order to protect against sudden moves. Number 6. Don't chase volatility. Wait for confirmation before entering trades. Let's move ahead. Best time to trade. We have the best time to trade. We have the London session, the New York session, the Asian session, and the Sydney session. These are the best time to trade. So depend on the high volatility, the liquid, and the best place to trade those during those sessions. Are you getting my point? So if you want to move fast, or if you want fast moving trade during London session, then you can trade between the 8 a.m. and 12 p.m. Eastern Standard Time. That is when liquidity and volatility are at its peak. In conclusion, liquidity and volatility are lifeblood of forex market. Liquidity ensures you can trade essentially with tight spread and quick execution. Volatility ensures creates opportunity and risky by driving price movement. A successful trader learns to balance both. Trading when the market is active and liquid, when there is managing a risk during volatile condition. The key is to understand when and how to trade, not just what to trade. Master that balance, and you will have the foundation for long-term success in forex trading. Forex trading section expand. Understand? Forex trading section explained. Tokyo, London, which is Tokyo, London, New York, and Sydney. So I will be teaching this section on my next video episode, and I'll be explaining everything for you, which is forex trading section, which I will be telling you the London, the New York, and New York session. So let's continue from the next video session right now. Thank you. So guys, welcome back again. Let's continue from where we stop. Forex trading session explaining Tokyo, London, New York, and Sydney session. The forex market operates 24 hours a day, 5 days in a week, if you don't know. But it is not active all the time. Instead, it moves through 4 major trading sessions, each representing a key financial center of the world: Tokyo, London, New York, and Sydney. Understanding each session is crucial for every trader because market activity, liquidity, and volatility varies depending on which session is open. Knowing when to trade can make the difference between the consistent profit and unnecessary losses. So in this context, we will explore each forex session in details, their characteristics, and the best time to trade for maximum success. The 24 hours market cycle. Unlike the stock market, which open and close daily, the forex market is continuous. As one major financial center closes, another opens, keeping the market alive around the clock. Here is how the 24 hours market cycle works. You can see it in the diagram. Sydney, we have the Tokyo, we have the London, and we have the New York, and the region is the Australia, Asia, Europe, and North America. And you can see their opening time and their closing time. Are you getting my point? Because time may vary slightly, daylight saving changes. Are you getting my point right now? So the overlap between sessions, especially the London and the New York, creates the most liquid and volatile period in the forex market, ideally for trading, and it is the best time to trade, and it is the best time for you to make profit whenever you are trading. Are you getting my point? Let's continue. The semi session starts from 9 p.m. and closes at 8 and closes at 6 p.m. And closes at 6 a.m. GMT. The semi session marks the start of the trading day. Why is the smallest of the four sections? It sets the tune of the market of what to comes in the market. The characteristic of semi session: low to moderate liquidity, slow price movement, best suit for traders who prefer calm market. Then the active currency pair then AUD/USD, NZD/USD and AUD/JPY. Since Australian and New Zealand dollar are major commodity driven economies, these currencies are mostly active during this time. Base trading strategy: you can use range trading strategy. Price often moves between tight range due to low liquidity. Number 2 is Tokyo session, which begins at 12 a.m. and stops at 9 a.m. GMT. The Tokyo session, also called the Asian session, is where the real action begins. It is the first major session of the day and represents the Asian financial market, including Japan, China, Singapore, and Hong Kong. Characteristics: moderate liquidity, stable, predictable price movement. Markets react to Asian economic calendar like Japan's GDP or China's trade balance. Price movements set early market sentiment for the day. Active currency pairs to trade during this period: USD/JPY, Euro/JPY, AUD/JPY, and NZD/JPY. Best trading strategy: focus on breakouts during economic release news, or trade JP or trade JPY pairs for consistent movement. Number 3, London session, which starts at 8 a.m. and stops at 5 p.m. GMT. The London session is the most active and liquid trading session in the world. London is considered as the financial capital of Forex, handling more than 35% of all daily Forex trading transactions. The characteristic of the London session is high liquidity and volatility, tight spread, fast price movement, and overlap with Tokyo and New York session. During the London session, most currency pairs experience sharp trend and increased volume, creating abundant trading opportunity. Active currency pairs during those periods: Euro/USD, GBP/USD, Euro/CHF and GBP and Euro/GBP. Best trading strategy: use trend following strategy or breakout trade during this session. Economic data for Europe and UK, like inflation and interest rates, can spark strong moves in Euro and GBP pairs. Then you have the New York trading session. The New York session is the final major trading session of the day and one of the most important. The US dollar is involved in nearly 90% of all forex trade. So when New York open, the market comes alive again. Characteristics of New York session: high liquidity, especially during London overlap, high volatility in the first few hours, price movement influenced by the US economic data, and activity slow down after London closes. At active currency pair during this period: USD Canadian dollar, Euro/USD, GBP/USD, and USD Japanese yen. The best strategy to use during this time is trading major news events like US job reports, CPI, or Federal Reserve statement. Use momentum trading or news trading strategy to capture fast move trend. Session overlap: the best time to trade. The most profitable time in forex are when the two sessions overlap, as liquidity and volatility both surge, and the best time to trade is during the Tokyo London session, which starts from 8 a.m. and 9 a.m. Light movement, minor overlap, understand. But during the London and New York session, which start at 1 p.m. and ending at 5 p.m., highest liquidity and strongest volatility. So why the London or New York overlap is the best? Highest trading volume of the day, number 1. Tightest spread, number 2. Big price movement, number 3. And news release from both US and Europe, number 4. If you are a day trader looking for maximum profit potential, trade during the London or New York overlap. When not to trade, avoid trading during low liquidity hours after the New York session closes. Weekend and holidays, market is tight and spread widen. just before major news events unless you are a skilled news trader. During this time, spread are high and prices can spike unexpectedly. Choose the right session for your trading style. So here is the type of trader and what will suit you. Scalper, best session is London stroke New York. Why? Because it has high volatility and price spread. Day trader, best sessions for you is London and New York overlap. Why? Because it has strong trend and liquidity. Swing traders, best session for you guys is London or New York session because it have clearly stronger long-term setup. Then beginners, best session for you is for during Tokyo or Sydney because it has lower market or less pressure. Choosing the right session depends on your time zone, risk appetite and strategy. If you live in Asia, trading the Tokyo session may be more convenient. If you are in Europe or Africa, the London session fits perfectly. The key takeaway in this video is this: the forex market opens 24 hours in a day, divided in 4 sessions, which is Sydney, Tokyo, London, and New York. Each session has unique characteristics and trading opportunity. The London session is most traded and most liquid, while the New York session adds volatility and volume. The London or New York overlap offer the best trading condition for most traders. Always match your trading strategy to the session's behavior. By understanding when the market is the most active, you can trade smarter, not harder. Take advantage of the best opportunity Forex offer and Forex has to offer to you. It is very, very important to know this. In conclusion, time is money and in Forex, time is everything. Mastering the Forex trading session helps you to know when the market move. Why it is mastering the Forex trading session helps you know when the market move. Understand? Whether you in early riser catching the Tokyo move open or night OS searching the New York close, there is only an opportunity waiting. You just need to trade at the right time. Time zone and market overlap in the forex trading. The key is perfect timing. One of the most powerful advantages of forex trading is the market is open 24 hours a day, 5 days in a week. Unlike the stock market, forex never sleep as trading moves from one global financial centers to another. But here is the catch: the forex market doesn't move with the same intensity all the day long. Understanding time zone and market overlaps help traders know when the market is most active, when to avoid trading, and how to plan trade around volatility. In this guide, you will learn how forex market zone work, why market overlaps matters, and how to make them maximize your profit. The global nature of the forex market, which is the forex is the standardized market and there is no central exchange. Instead, it operates through a global network of banks, brokers, and financial institutions spread across different time zones. And this creates a rolling 24 hours trading day divided into 4 major sessions based on key financial centers, which I have explained before. If you can look at this chart properly, you can see the Sydney, Tokyo, London, and New York. Are you getting my point now? So you need to know why the time zone matters. Time zone matter because the forex market span the globe. So time zone matters. When the London open, the Euro and British pounds ten gain momentum, and when the New York open, the US dollar based pairs dominate. During the Tokyo session, the JPY, AUD, and NZD pairs become most active. Understanding this cycle helps you trade when liquidity is highest, avoid period of low volatility, plan trade around economic news release, and match your strategy to the right trading session. Then market overlap. Where is the magic happen? Market overlap occur when trading sessions are open at the same time. These are the most active and liquid times in the forex, when major institutions and retail traders worldwide are participating. And here is the breakdown of the key overlaps. So if you can look at my chart, you can see the Tokyo or Sydney, and you can see the Tokyo, London, and you can see the London and New York. That time and the time at which the currency pair is being traded and the main currency that is needed to trade during those period. If you can look at this diagram, you can see them very, very well. And the market behavior ranging from the moderate activity, transitional phase, and the highest liquidity to the strongest volatility. Are you getting my point right now? So let's continue. Sydney or Tokyo overlap, which begins from 12 a.m. and stops at 6 a.m. These overlap markets marks the early part of the trading day, so it is not usually active like that, and it is not usually busy, but it sets a stage for Asian market. So it features the moderate and volatility and it features the market. So this thing is basically saying both the Sydney market, the Tokyo market, the London and New York market is very, very high and active. Understand? But the London and New York overlap, which begin from 1 p.m. and ends at 5 p.m., is the most important and active period in the entire forex market. So when the two largest financial market center overlap, the market explode and the liquidity and volatility comes in. So here are the futures: highest trading volume of the day, tight spread and fast execution, major news release from the US and Europe, strong price trend and breakout. Best for all trading style, scalpers, day traders and swing traders. Perfect for trading Euro USD, GBP USD, USD JPY and USD Canadian dollar. When the market is quiet, while the forex market is technical, always open, not all the time is ideal for trading. There is a period of low liquidity, such as the New York session closes or during holidays, can lead to wider spread, lower price movement, and unpredictable spike. So you need to avoid during this period. You need to avoid quiet time in the market. Understand? You need to avoid quiet time in the market. You only need to trade during when the market is active, and you need to understand this tip for managing time zone. Use a forex clock. Plan trade ahead. Stick to a routine. Avoid overtrading and watch a daylight trading time. Understand? But the key takeaways in this video is this thing: forex operates 24 hours every day. The market overlap are the best time to trade forex, especially during the London and the New York overlap. Then time zone determine market activity in the market. Also make use of forex world clock or economic calendar to plan your trade to be more effectively. Understand? So you need to understand it very well. Mastering time zone and overlaps gives you edge of timing on one of the most critical skill as a forex trader. So it's a very critical skill and it's a forex trader for you to know how to master your time in forex trading. It will help you a lot. Then let's continue. The final conclusion. In forex, timing is everything. By understanding global time zone and market overlap, you can trade when the market is mostly alive and avoid it when it is asleep. When you do trading the calm Asia hours or the fast-paced London New York overlap, success comes from being in sync with the market rhythm. Remember, the right timing turns strategies, good strategy into a great result. So in all this thing that is happening, you need to understand this, that learn to be at the right time and at the right place during the market condition. Understand? Learn to trade during the right time. You need to master your time very well. You need to know when it is right time to trade during the forex market. It will help you a lot. So that is basically what this place is telling you. Understand your time zone and your time overlap helps you to make profitable trading. Are you getting my point right now? So if you have watched this video up to this moment, please make sure to like this video, make sure to subscribe to my YouTube channel, and also make sure to comment down below if you have any single question concerning this video. Also make sure to share this video to your loved ones or anyone who wants to learn how to trade forex. Make sure to also comment down below, ask me any question, and I will see you on my next video episode. Please make sure to watch the continuation of this video in my next video episode, because I'll be going to the third episode on this video, which will be on my next video episode. And I will see you on my next video episode, which I will be telling you my third episode of this video, which I will be breaking down more and more the forex trading basis. Bye for now, and I will see you on my next video episode. Thank you, take care, and bye for now.